Good evening and welcome to our 2025 first quarter financial market update call at Great Lakes Private Wealth. Good evening, everyone. This is Dan Murphy, founder and chief investment officer of Great Lakes Private Wealth. I've titled tonight's call Uncertainty Everywhere. The call tonight is being recorded and will be on our website, greatlatesprivatewealth.com, shortly afterwards. Now let's get into what happened in the market in the first quarter and what we see going forward. Pat Patin will give us some data, and then I'll update you with my outlook on the markets. Pat?
Thank you, Dan. This is Pat Patin, partner and portfolio manager of Great Lakes Private Wealth. Before I get started, I must remind everyone that past performance is no guarantee of future results, and all the information we'll be providing is from sources we believe to be reliable, but there's no assurance that the information is accurate or complete. Starting off with some key stats for our call. Year to date, the 2025 price return for the S&P 500 is down 5.5%. The Dow Jones Industrial Average is down 4.7%. The Russell 2000 Small Cap Index is down 11.4%. The NASDAQ Composite is down 9.6%. International stocks, represented by the EFA Index, are up 12.26%, and gold is up 26.4%. And bonds, represented by the Bloomberg Aggregate Bond Index, total return is up 2.3%. Today, I wanted to frame the environment we're operating in because it's critical to understand the pressures weighing on the stock and bond markets right now. There are two leading schools of thought as of today for the future of the economy and markets. One, you've got the bull case, and it's a continued consumer with durability. A few tariff deals get made. Artificial intelligence is still a large tailwind. There'll be the tax cut extension, and that eventually the Federal Reserve will step in if necessary. On the other side, you have the bear case that I hear the most is that economic pressures are ahead of us, not behind us, that shipping is drying up, that there will likely be shortages on the shelves soon, and consumers will be paying higher prices, and very few businesses will be expanding. These two polar opposite views are why we're titling tonight's call Uncertainty Everywhere, as no one knows which view is right, and it explains why the market has been so volatile over these last few weeks. The future state of the consumer and policy is key to seeing which viewpoint wins out. Treasury Secretary Scott Bessent was quoted a few weeks ago that the top 10% of Americans are now about 50% of consumption, and that it is at an unsustainable equilibrium, in her opinion, that the administration is looking to undo. Along with the 50% of spending, high-end consumers now own 87% of stocks, 84% of private businesses, 67% of total wealth, and 44% of real estate. This makes our economy's connection to the stock market and real estate even more important than in prior cycles, with much of the spending done by those most invested in financial assets. High-end consumers make up the majority of spending today, as I mentioned, especially as the U.S. economy has shifted towards services. In 1959, 55% of consumer spending was on goods and 45% on services, but today, just 31% is spent on goods and 69% is on services. This is reflecting how much wealthier America increasingly values experiences, healthcare, education, personal services. This transition to a service-driven economy is a positive sign of rising living standards. This has also shifted with jobs. In 1945, 43% of private U.S. jobs were manufacturing jobs. 43%. Today, just 9%. So with that information as a backdrop, what key things are we focused on to see if we can be in bullish or bearish camps for this market? First, it's becoming quite clear that the Federal Reserve and the government are not going to bail out the stock market in the short term. With the overhang of tariffs and looming government spending cuts, policy support that investors had grown used to over the past decade isn't readily available here. That leaves the market more exposed to economic fundamentals and earnings without the safety net of aggressive stimulus. If there are hints that the Fed could step in or major government spending could occur, that would change the market's view very dramatically. A key technical level we're closely watching is what is known as the death cross, where the 50-day moving average on the S&P 500 crosses below the 200-day moving average. This is called breaking trend. And historically, when markets break trend and fail to reclaim it quickly, we often enter periods of broader market weakness, where the average yearly return is near zero when below versus a positive 9% when going back above, going back almost about 100 years here. And regaining that level with conviction is important for any hope of a sustainable recovery. Otherwise, the path of least resistance tends to tilt lower. Adding to the cautious tone, the stock market's performance during President Trump's first 100 days has been among the worst for a president in modern times. In mid-April, the stock market was on track for the worst April since the Great Depression and worst start to any presidency since data began being tracked back in 1928. While we've rallied nicely since, this just shows you how drastic of a move we've seen in the stock market in less than a month. While political headlines often dominate short-term moves, it's a reflection of deeper concerns about growth, inflation, and policy uncertainty here. On the positive side, we have one clear major win here we've seen in the last week, that we experienced what we call a technical condition as a breadth thrust. This is an indicator that measures strong upside participation across a wide variety of stocks. Typically, these signals can mark important turning points and have yet to see the market down 6 or 12 months later. However, we're somewhat hesitant to fully embrace it right now because prior breadth thrusts occurred when the market was historically much cheaper from a valuation standpoint. Today's valuations remain elevated compared to past cycles. Even in weaker markets, it's important to remember bear markets can produce powerful rallies. We saw it during the dot-com collapse from 2000 to 2002, the financial crisis in 2008, and again in 2022. During the tech bubble, the S&P 500 had 7 rallies that averaged 14%, and all were less than 5 months in length, while still losing 49% over 2.5 years. During the global financial crisis, the S&P had 11 rallies of 10% or more, with an average of 2 months in length, while still losing 57% over 1.5 years. Sharp counter-trend rallies can create a false sense of security before the broader downtrend could reassert itself. Now, here's a quote that I've been talking to clients about lately, that there are decades where nothing happens, and there are weeks where decades happen. And that quote sums up nicely what's occurred over the last month. We're seeing just how quickly things can change. Sometimes months of price movements happen in a matter of days, and April was a perfect example of that, with extreme volatility packed into a few trading sessions. In 15 days, the S&P did the following: declined 12% in 4 days, rallied 9.5% in a single day, fell 5.5% in 7 days, and then gained 6.3% in 3 days. Talk about a roller coaster. This was 4 months of volatility in less than one. And it's just another reminder that staying nimble, disciplined, and grounded in your process is critical in environments like these. We'll continue to monitor these developments carefully, particularly price action around this 200-day moving average I mentioned, any valuation resets, or any follow-through with these breadth thrust indicators I mentioned, to assess whether we're seeing a true bottom forming or just another rally in a more difficult market backdrop. A focus for us will be the benefit of hedging strategies we employ that could provide some stability to portfolios as we look to make these volatility waves smaller for our clients, like we have done over these last 2 months since our last call. And with all that, I will now turn the call over to Dan.
Thanks, Pat. Let me start with a brief summary of what I shared during our last call in January of 2025. I said that interest rates would likely stay at current levels or possibly move slightly lower. I mentioned that foreigners were buying record amounts of stocks, a historically poor long-term indicator, as they were also heavy buyers in 1987, 2000 during the dot-com bubble, and 2008. None of those times turned out to be great times to buy. I also noted that stock market valuations were not cheap and that we would expect higher volatility in 2025. Indeed, that is exactly what we've seen. We've had 3 consecutive days of 1.5% moves in the stock market for the first time since late 2020. As Pat mentioned just moments ago, there are decades where nothing happens, and then there are weeks where decades happen. We've just experienced one of those rare periods. The market was acting strong early in the year, buoyed by optimism around the new administration and a robust economy. I want to review our exact words from our call on January 27th of this year. Here's what we said. While the new administration has eased regulatory pressures, tariffs introduced during the first Trump administration have remained an overhang, complicating global trade dynamics. President Donald Trump has repeatedly threatened to dramatically expand tariffs. This move could affect trillions of dollars in trade and reshape prices for everything from cars to medication, while potentially straining relationships with key U.S. trading partners. Imported goods are the key driver of the American economy, totaling $2.9 trillion in 2024, according to the U.S. Census Bureau, with China, Canada, and Mexico accounting for over 40% of that volume. It's these top trading partners that Trump has frequently criticized, threatening 10% tariffs on goods from China and 25% tariffs on goods from Mexico and Canada. I would call that commentary from January spot on with what's been occurring the last 2 months. In March, President Trump announced new tariffs on many foreign countries, and on April 2nd, we learned the tariffs would not be as expected at 10%, but much higher, and would apply to many countries, not just China. The announced tariff on China was 145%. To provide some context, last year the U.S. imported $459 billion in goods from China, and we exported $143 billion in goods to them. It's this dramatic change in the expectations of tariffs that has ramped up the stock market's level of uncertainty, which in turn leads to all the volatility we're currently seeing. Tonight, I'll review the key factors we're watching to determine whether this decline is over or if it has further to go. Specifically, I'll cover the stock market's valuation, investor sentiment, interest rates and inflation, as well as a couple of key statistical indicators we're watching very closely to help us determine where we go from here. Let's start with the stock market's valuation. The key index we use for valuation is the S&P 500. Analysts started the year with a projection of $265 of earnings per share for the S&P 500. The most common tool to analyze valuation is the P/E ratio of the S&P 500. That's the price divided by the earnings. At the beginning of the year, the S&P 500 was 5,881. The 2020, $45 per share. 58.80 $45. That gives us a P of around 20 times earnings. The median PE for the last 60 plus years has been 17.9. The median PE over the last 20 years has been 16.28. A key question we must ask is, what was the PE ratio at the end of major bear markets of the past 40 years? In 1987, the low PE at the end of that bear market was 13.4. In 2000, the dot-com bubble, the low PE was 19.1. At the end of the great financial crisis in 2009, the low PE was 12.4. In 2020, at COVID, the low was 18.8. And in 2022, the low PE was 20.5. So if we throw out the great financial crisis and average the lows, we get an average PE at the bottoms of around 18. If the economy slows just a little and earnings are able to stay at the same $245 per share times the average low, that gets us a market level of 4,410 on the S&P 500. That is approximately 20% lower than where we are today. If earnings start to fall, then we could see more downside for the market. Now let's review sentiment. Clients that have been with us for a long time know how much importance we put on sentiment. In the last 3 weeks, we've had extreme readings in sentiment from almost every one of our indicators. What this means is that with all the talk of tariffs, potential impact on the economy and inflation, it has scared the daylights out of investors. The fear and greed index from CNN got down to 3 2 weeks ago. At the COVID lows, it was 0. Another sentiment tool we use is the Ned Davis optimism pessimism model, and it got as low as 4 several weeks ago. It has only gotten that low a few times. Notably, in 2020, the low was 7. We also look at the American Association of Individual Investors, and we look at how bullish investors are. It got to a reading of only 19.1% of investors being bullish who take the survey. The COVID low was 20%. So in summary, sentiment has clearly reached levels associated with major market bottoms. This will lead to at least a major pause in the downside action in the market. Sentiment is just one indicator, or think of it as one leg of a chair. This is a positive for the markets, and most investors have gotten wise to the fact that when things get this negative, as far as sentiment goes, it usually has presented itself with a good buying opportunity over the last 10 years. My only worry is that investors start to believe this will always work no matter what. It's an important piece, but it must be taken as just one piece. Again, to use a metaphor, a chair cannot hold itself up with just one leg. You usually need 3 legs on a chair, and 4 legs is best for maximum stability. Now let's turn to inflation. As the economy cools down and slows further, inflation has actually started to come down. This is another positive. Look at oil prices since the beginning of the year. Oil's down 12%. As airline travel has slowed, ticket prices for airlines has come down. MarketWatch News Service reported over the weekend that airfares are down over 4% for the month of April. Egg prices are down 45% year to date, but are still up 24% from a year ago. Aluminum is down 4%. Last month's CPI was annualizing at 2.4% versus the Federal Reserve's target of 2%. The big concern now is the impact of potential tariffs on inflation. The United States imports so many goods. This includes finished and unfinished goods. If we raise tariffs a lot, then the price that manufacturers must pay for components to build things that have imported goods in them will translate into consumers having to pay higher prices for these goods. This has the potential to raise the level of inflation by a considerable amount. The tariffs will hit intermediate goods produced by U.S. manufacturers much harder than finished goods. About 40% of all goods imported from China are intermediate goods, which means they're used to help build many finished products. Think of it this way. If a toaster or refrigerator has parts in it that are imported and are used to build the product, then the total cost of the finished product must go up. The manufacturer has to either pass that cost on to you, the consumer, or eat the added cost and make less profit, or even lose money on the finished product. Large companies have a lot more cash in the bank and are way more flexible than smaller companies. This dilemma of how to offset these higher prices is causing companies large and small to take a wait-and-see attitude to determine exactly how the tariffs play out. John Maulding, an economist, wrote recently that another word for wait and see is paralyzed. I agree with him. How long can companies operate in a wait-and-see mode? The bigger companies can go longer, the smaller ones cannot. It was not long ago that we were dealing with the COVID supply chain disruptions. That was only 5 years ago, and it took companies a few years to get back to normal. We literally may be walking into the same problem again if we don't get these tariffs handled shortly. The supply chain disruptions led to much higher inflation due to the lack of supply of certain goods. The economic forces of supply and demand usually take over, and we end up with much higher prices for many different goods that are being produced all around the world that U.S. consumers rely on. Peter Bookvar of CIO Bleakley Financial Group recently wrote that we should expect shortages on shelves within the next 30 to 60 days. Cancellation of Chinese freight shipments have begun as companies delay shipments until they understand the cost impact from tariffs and how long they may actually last. The executives of Walmart, Target, Home Depot recently met with President Trump last week to explain the impact to their businesses. Trucking activity out of the Port of Los Angeles is down 23% year to date. Craig Fuller of Freightways, a trucking and shipping company, has said if tariffs don't end soon, massive layoffs are coming to the West Coast trucking sector. Shipping traffic's down over 42% out of China to the U.S. If this does lead to inflation on goods, layoffs won't be far behind, and higher interest rates will follow as well. The tariff uncertainty helps to explain the reason gold and many gold stocks have been doing so well as an asset class. Gold is at $3,350 an ounce, which is near all-time high. Gold is up by over 25% so far this year after being up 28% last year. This is a remarkable run. J.P. Morgan just predicted they think gold could be over $4,000 an ounce by the end of the second quarter. If inflation starts to ramp higher, many analysts think gold has the potential to go as high as $5,000 an ounce. So as with everything, there's a chance that everyone is getting ahead of themselves where gold is ultimately going to end up. Or as I like to say, be careful, everyone, about sitting on the same side of the boat. But the trend is clearly higher. The good news for gold investors is that gold as an investment is not over-owned by the public. Most institutions have estimated that the average investor owns only between 1% and 3% of gold in their investment portfolios. Now let's move on to interest rates. The Fed Reserve had a meeting in March and they did not lower rates. They said they're watching the data. The key things the Fed is responsible for is maintaining stable prices, or said in English, keeping inflation around 2 to 2.25%. The second mandate of the Fed Reserve is to make sure we have stable employment. Let's evaluate both of these key mandates of the Fed Reserve. Inflation last month, as measured by the CPI, Consumer Price Index, was at 2.4%. So that's still slightly higher than what the Federal Reserve's mandate is of 2 to 2.25%. If we look at unemployment last month for the month of March, which was reported in April, there were 228,000 jobs created. The unemployment rate last month was 4.2%. The lowest it's been recently was April of 2024 at 3.9%. Unemployment has not increased much at all. The Federal Reserve's two key mandates, inflation and unemployment, are behaving very nicely at this time, So there's no reason for the Federal Reserve to change the level of interest rates. The key wild card, though, is if tariffs do go into effect, will we get higher inflation, which will force the Fed to raise interest rates from their current levels? If the tariffs are enacted and inflation does not go up and the economy were to start to slow, the Federal Reserve could begin to lower rates. This just highlights why we titled tonight's call, Uncertainty Everywhere. The Federal Reserve does not want to lower rates at this time because they don't know for sure what the impact on inflation the tariffs will have, and if they are going to be enacted or sustained for any length of time. So they remain as well in a wait-and-see mode. This is just more uncertainty as it relates to the current direction of interest rates. Another factor is the tension between President Donald Trump and the Federal Reserve Chairman, Jerome Powell. In fact, just last week, the president was threatening to fire Jerome Powell if he did not lower interest rates. The Federal Reserve is an independent body and cannot be bullied by the president. Just the mention of firing Chairman Powell caused the market to fall, and interest rates actually started to go up. President Trump then made a statement a couple of days later saying he was not considering firing the Federal Reserve Chairman, and that helped calm the markets down. President Trump would like to see lower interest rates, which would help the economy in a big way, especially if tariffs are enacted. The other main indicator of inflation that's important to the Federal Reserve is the PCE. PCE stands for Personal Consumption Expenditure. Last month it was at 2.5%. This was lower than most analysts were expecting. Tomorrow, April 30th, we'll get the next release of the PCE. And this coming Friday, May 2nd, we'll get another report on unemployment from the Labor Department. And that will give us a little bit more indication of how well employment is holding up with all the uncertainty as it relates to the economic outlook and the threat of tariffs. If you remember in 2020 during COVID, the Federal Reserve lowered interest rates dramatically due to a severely slowing economy. As inflation started to pick up, the Federal Reserve was very slow to raise interest rates, which allowed inflation to go higher than they would have preferred. That then forced them to start raising interest rates dramatically in 2022 and 2023. So in summary, the Federal Reserve is very cautious in making any mistake again by lowering rates too quickly and allowing inflation to take off. Another factor I believe that's affecting interest rates is the $37 trillion of national debt the U.S. government has at this time. The interest alone at 4% will be approaching almost $1.5 trillion a year. The concern is how much can the U.S. government continue to finance without causing interest rates to go up? Just for reference, the U.S. government in 2024 took in revenues of $4.9 trillion, and they spent $6.5 trillion. Defense was $872 billion. Health insurance, Medicare and Medicaid amounted to $1.7 trillion. Interest on the national debt in 2024 was around $869 billion, or about 13% of expenditures. That makes the average interest rate on the national debt at about 2.4%. Well, today, one-year T-bills rate is 3.93%, so the amount of interest is going to go higher if rates stay where they are currently. As the total amount of debt goes up and interest rates go up, the concern becomes, will foreign countries continue to help finance the U.S. debt? The tariff debate has created a lot of talk that China, Japan, and many other foreign countries are going to stop buying our U.S. treasuries and boycott buying these bonds. This could ultimately become a major long-term problem. People have been talking about this issue for the last 10 years and saying it will not be a problem. Up until now, that's been true, but that could change. The Trump administration has been talking about getting rid of waste, fraud, and abuse within the federal government. I'll not address that in detail on this call, but I do want to share some numbers with you. The federal government employs 2.4 million people. This does not include military personnel. Just for the context of the next three largest employers in the United States are Walmart, 1.6 million, Amazon, 1.1 million, and United Parcel Service, 443,000 people. If the federal government eliminates 10% of its workforce, that could amount to 240,000 people losing their jobs. The reason I bring this up is because that would have a short-term negative effect on the U.S. economy as well. Now, I want to talk about some technical statistics we watch very closely to help us decide if we're bullish, neutral, or bearish. Pat mentioned earlier on the call one of the indicators that has a very good track record of keeping you invested when the market's doing well and getting more cautious when the market's going to struggle or go sideways. This is where we compare the 50-day moving average of the S&P 500 to the 200-day moving average of the S&P 500. It seems very simple, but it has worked really well over a long period of time. The theory behind this indicator is that if the 50-day moving average is above the 200-day average, it's sending us a signal the market's healthy and trending upward. If the 50-day is below the 200-day, then it says the market's unhealthy and trending lower. For those of you listening on the call on their computers, we put up a chart. We have the data all the way back to 1929. Since 1929, whenever the 50-day is above the 200-day, the market has returned 9% per year. When the 50-day is below the 200, the market has returned 0.2%, so less than 1%. Let's look at the most recent bullish signal, which occurred on February 2nd of 2023. The S&P 500 was at 4180. Now, on April 14th, just a couple weeks ago of this year, we got a bearish signal. That the S&P 500 was at 5,406. As of today, this indicator is still rated negative. For us to get more positive about the market, we'd like to see this indicator turn positive at least for a week or two. I'd like to summarize, again, looking at this Zweig thrust indicator. Again, Pat brought that up, and you can see that since the last 50 years, since World War II, in 12 months later, the market has never been lower when we've had a Zweig thrust. So again, that's another short-term positive that we're looking at. If I summarize exactly what we're looking for us to get more bullish on the market in the coming weeks and months, I would do it this way. As we mentioned at the beginning of our talk, we talked about valuation as it relates to the market. If S&P 5 earnings hold up and we get closer to a P/E ratio of 18, that puts the market closer to the 4,400 level, which could be an attractive place to buy. Sentiment is at levels recently that have historically represented very good entry point to buy stocks. So currently that condition has been met. Inflation's been under control and improving, but with the threat of the tariffs and reduced shippings of goods that's occurring, the potential for supply shortage is growing by the day. This could lead to higher inflation, which would prohibit the Federal Reserve from lowering interest rates anytime soon. Over the next several months, I'd like to see how the economy does, and do we experience any supply shortages, and what impact it has on the inflation reports. If inflation stays under control over the course of the next several months and into the fall of this year, and the economy slows ever so slightly, the Federal Reserve will then have the room to lower interest rates, which would be very bullish for stock prices. I would also like to see the 2017 tax cuts be made permanent. If they're not, then higher taxes will automatically slow down the economy. not ideal for most Americans and U.S. corporations. As far as how prepared U.S. corporations are going into the threat of all these tariffs, I believe they're more prepared and in the best financial shape they've been in many years. They have reduced debt and stockpiled cash on their balance sheets. So I would argue they are prepared for an uncertain economy. If we see companies' earnings start to reaccelerate, that would be another huge positive to support higher stock prices. On a technical level, I'd like to see the 50-day moving average go back above the 200-day average. We're watching that as well as many other important things, as you can imagine, to help us get through this uncertain period in the markets. I know I show this chart over and over, but there's a reason for it. Stocks historically have been the best place to invest your money in the long term. And as you can tell, the average S&P return since the 1920s, every 10-year period, has resulted in about a 10% per year return. The next closest thing from different would be gold at 5.9, real estate 4.6, treasuries at 4.3, treasury bills at 3.3. As many of our long-term clients know, we've navigated through these challenging periods before, and this time is no different. Why have we been able to succeed over many years of investing? I sum it up this way: discipline, independence, and experience. Asset class. We can invest all our money in bonds or none at all. If utility stocks aren't attractive, we don't own them. Our independence allows us to invest where we believe your money will be best served. That flexibility is especially important in an environment like today, where the level of uncertainty is as high as I've seen in many years. We're also free to select the stocks we like rather than being forced to own certain names simply because they're part of an index. That independence is a real advantage. And finally, we bring experience, something many money managers simply don't have. They haven't been investing as long as I have or with the same consistent success. As always, we'll remain disciplined this year. We'll continue to seize opportunities as they arise, and we'll stay cautious for as long as necessary to protect your hard-earned capital. We know that market volatility can be stressful, so please don't hesitate to reach out if you have questions or simply want an update on your portfolio. What excites me is that, in my experience, these kinds of environments often lead to great investing opportunities, just like March of 2020. Now, I want to be clear, I don't think we're there yet, but I've been doing this a long time, and in my view, another opportunity like that will come. We just need to be patient and wait it out, and the clarity and decisiveness to act when the time does come. I believe this time will be no different. Thank you for listening, and have a good evening.
Thank you all for joining us, and please join us for our next update, which will be in the evening of July 29th of 2025. This presentation is for informational purposes only and is not an offer or solicitation to purchase or sell any security or employ a specific investment strategy. It is not designed for or individually tailored to any particular investor and is not intended to be suitable or in the best interest of all types of investors. This information should not be relied upon as research or investment advice and is strictly for illustrative, educational, or informational purposes. Opinions expressed in this presentation are subject to change without notice. There is no guarantee that any forecast made will be realized. Commodities, including precious metals, carry substantial risk and have experienced periods of extreme volatility. Investments in commodities may be affected by changes in overall market movements, commodity index volatility, changes in interest rates, or other factors affecting a particular industry or commodity. Past performance is not a guarantee of future results. Investing involves risk, including the possible loss of principal. Index performance is for illustrative purposes only and does not include dividends otherwise noted. Indexes are unmanaged, do not incur management fees, costs, and expenses, and cannot be invested in directly. Data contained herein from the third-party providers is obtained from what are considered reliable sources. However, its accuracy, completeness, or reliability cannot be guaranteed. Data is as of the date noted and subject to change. Investment advisory and financial planning services offered through Summit Financial LLC, an SEC-registered investment advisor, doing business as Great Lakes Private Wealth. Summit Financial LLC does not provide tax or legal advice. If you require such advice, you should contact the appropriate tax or legal advisor. Thank you.